On June 7th, the Bank of Canada announced that they're raising interest rates by 0.25%. So I want to talk about how this affects you and what you can do to overcome these challenges. What's going on, everybody? My name is Andrew, and if you are interested in getting a property this year in 2023, or you have a mortgage that's coming up for renewal, or you're on a variable rate mortgage and you've recently heard about these recent interest rate hikes, you might want to know how this is going to impact you. So I want to explain this in simple terms so you can understand it. Now, why are interest rates going up? Well, the main contributing factor is that we saw inflation rates go from 4.3% in March to 4.4% in April. Now, we understand that when inflation happens, all kinds of things are getting more expensive. We've already seen groceries getting more expensive, rents are getting more expensive, and they're raising mortgages, which is in fact contributing to the cycle of everything becoming more expensive in general. How are people going to manage? From the real estate and mortgage perspective, this is how it affects you. There are three types of mortgages you may be on. You have the variable rate fixed payments, variable rate with fluctuating payments, and then you have the standard fixed payment mortgage plan. Let's use an example where you're holding a mortgage of $750,000. Now let's say you're holding a variable mortgage with fixed monthly payments. Your monthly payments aren't changing until the mortgage comes up and it expires or it's up for renewal. But what you do have is you have a fluctuating interest to principal proportion payment. Now what this means is that when you're paying your mortgage, a percentage of your monthly payments goes towards interest and then another percentage goes towards principal. And this is going to fluctuate as variable rate interest rates change. So if you are on a variable rate, which today is about 6.7%, and you have a $750,000 mortgage, that is a monthly mortgage payment of about $5,000. Now what happens if it goes up by 0.25%? Well, that means that the proportion of interest being put towards the bank versus principal going towards you in your monthly payment is going to fluctuate. More of that money that you're paying every month, that $5,000, is going to be going towards interest than principal. Now let's apply that same example to a variable rate mortgage that changes as interest rates fluctuate. If you are at about 6.7%, you're going to be paying $5,000 a month to the bank. If the interest rates rise by 0.25%, this is going to affect you by about $100 a month. This doesn't sound like it's going to really affect you that much, but if we think about it, a $5,000 mortgage every month is already quite a bit to be paying on a $750,000 mortgage, but this is not where the kicker is. Where the kicker comes is on people who were and have been on fixed rate mortgages and have mortgages coming up for renewals. Now, fixed rates are coming in right now generally around 5%. And if you get a fixed rate mortgage on a $750,000 mortgage at 5%, you are looking at a monthly payment of $4,362. What about people who got mortgages 3 years ago, 5 years ago, and had mortgages locked in for, let's say, 3% interest? They are now coming into a renewal period where their monthly mortgage payments are going to go from $3,549 all the way up to $4,362. This is a difference of $800 a month. And with rising costs of everything, groceries, gas, consumer products, everything, add an $800 increase in your bill to that, some people are not going to be able to afford it. And what's this going to do? This is going to put a lot of people into a position or a train of thought that's now going, should I sell my property in line with when my mortgage comes up for renewal? Maybe I'll just rent a little while. This is going to throw a bunch of properties into the real estate market. But now you might be thinking, what's going to happen to the people who bought properties at an inflated price and cannot sell them to anybody else today? They may stand to lose equity in those properties and may not be able to exit comfortably. What's this going to do? This is going to increase inventory into the market and bring prices down. Now, whether or not this is going to affect the market tremendously is really debatable, and we got to see how immigration plays out and how other factors in our economy are also going to influence the real estate market. So what do you do now? How do you adjust in this difficult economy? If you can't increase your personal income, you need to increase your property income, whether you're renting out your garage, building a garden suite, adding another unit in the basement for an in-law suite, or a duplex conversion, anything that you can do to draw an income, because with rising interest rates also come rising rents, and that is something that you can capitalize on, take advantage, since you do already own a property. And if you're really serious about growing and scaling in real estate and want to turn this challenge into an advantage that you can capitalize on, make sure to click on the link in my bio, because we have tons of training programs on how you can come out on top in real estate. Hope you enjoyed this video. Make sure to like, subscribe, and I'll see you on the next one.